Hello, Zac. What you see before you is a visual representation of your portfolio. In review, I found that you have 3 stocks that upon transaction will produce a short-term gain or loss, and also 3 stocks that will produce a long-term gain or loss. Capital gains and loss are classified as long-term or short-term, depending on how you hold the asset before you sell it. If you hold it for more than 1 year, your capital gain or loss is long-term. If you hold it 1 year or less, your capital gain or loss is short-term. If you have long-term capital gains in the excess of your long-term losses, you have a net capital gain to the extent your net long-term capital gain is more than your net short-term capital loss, if any. The tax rate that apply to net capital gain are generally lower than the tax rates that apply to other income. For lower income individuals, the rate may be 0% on some or all of the net capital gain. If your capital losses exceed your capital gain, the excess can be deducted on your tax return and used to reduce other income such as wages up to an annual limit of $3,000 or $1,500 if you are married filing separately. If your total net capital loss is more than the yearly limit on capital loss deductions, you can carry over the unused part to the next year and treat it as if you incurred it in that next year. Looking at your portfolio, XYZ had a loss, would have a loss of $1,200 at the marginal income tax rate. IUT would have a gain of $1,100 at the marginal income tax rate. ZUO would have a gain of $2,000 at the marginal income tax rate. APP would have a loss of $200 at the long-term capital tax rate. ABC would have a gain of $500 at the long-term capital tax rate, and UIT would have a gain of $1,800 at the long-term capital tax rate. Even the best investors don't pick winners every time. If you bought stock that's declined in value and decide it's time to jump ship, timing the sale and reporting it properly on your taxes could help you offset some of the loss. You can use the losses to cancel out some or all of your capital gains for the year. If you sell the stock in a year, which you don't have losses to offset, or you have more losses than gains, you can deduct up to $3,000 in losses that don't offset gains. Calculate your net long-term loss separately from your net short-term loss. If you carry forward a loss, it keeps its category of long-term versus short-term, so you can't simply lump them all together. For example, if you have a short-term loss of $1,200 with XYZ and a long-term loss of $200 with APP, but also a long-term gain of $1,800 with UYT and a short-term gain of $1,100 with IUT, you have a net short-term loss of $100 and a net long-term gain of $1,600. Short-term losses are more advantageous than long-term losses because short-term gains are taxed at the higher ordinary income tax rates. Long-term gains, on the other hand, are taxed at the lower capital gains rate. For example, assume you have $5,000 in short-term gains and $5,000 in long-term gains. If you have $5,000 short-term loss carry forward, you wipe out your short-term gains, and the $5,000 of the long-term gains are taxed at the lower rate. However, if your $5,000 carry forward is a long-term loss, it wipes out the long-term gains, leaving you with $5,000 taxed at the higher ordinary income rates. It's a lot of information in a very short period of time, but I'm always available for you if you have any further questions. Thank you.